BlackRock just quietly repositioned trillions away from long-term U.S. Treasuries. And right now, February 9th, 2026, with the national debt smashing through $38.56 trillion, this isn't some minor tweak. It's the loudest institutional signal for a massive U.S. stock rotation in over a decade. Let that sink in. The world's largest asset manager, sitting on more capital than entire economies, is underweighting the so-called risk-free backbone of global finance, dumping exposure to long-dated bonds while flooding into emerging markets debt and selective global plays. This move isn't panic. It's calculated, surgical, and it's screaming opportunity for anyone paying attention before the herd wakes up. Here's what actually happened in the last few weeks. Rick Rieder, BlackRock's global fixed income chief, the guy who manages trillions and is literally in the running to become the next Fed chair according to prediction markets, went on Bloomberg and said straight up, he's slashing U.S. investment-grade and high-yield credit exposure because spreads are at historic tights, valuations are stretched, and bond supply is exploding. Instead, he's ramping up emerging market debt, local currency, hard currency, where yields are juicier, valuations scream value, and a softer dollar acts like rocket fuel. This isn't a full exit from America. It's a strategic pivot away from long-duration treasuries that BlackRock has been telegraphing since late 2025, when they turned tactically underweight in their annual outlook. Now, zoom out. U.S. national debt just hit $38.56 trillion as of early February, up $2.35 trillion year over year, growing at $6.43 billion per day. That's not a typo. Interest payments alone are devouring over $1 trillion annually, eclipsing defense spending. Think of it like a family that's maxed every credit card, home equity line, and payday loan. Eventually, the interest eats the income, and lenders get nervous. BlackRock sees the supply pressure coming, $10 trillion in treasuries rolling over soon, massive AI-driven corporate borrowing adding to the flood, fiscal deficits that won't quit. Long bonds? They're the first to feel the pain as term premiums rise, yields grind higher, and duration risk bites hard. Here's why this matters for U.S. stocks right now. When the biggest player in fixed income pulls back from long treasuries, capital doesn't vanish. It rotates. Less demand for bonds pushes yields up, which squeezes borrowing costs, forces weak hands to liquidate, and funnels money into equities hunting real returns. But not just any equities. Quality, AI-exposed, low-debt winners. BlackRock remains pro-risk, overweight U.S. stocks on the AI theme. That's the dirty secret the mainstream buries under bond caution headlines. They're not fleeing the U.S. They're repositioning for a world where bonds no longer act as the reliable ballast, and stocks, especially tech, infrastructure, and productivity monsters, become the growth engine. Quick note before I dive deeper. If you're tired of getting the news after the move's already priced in, head to the pinned comment for Buffett Academy. That's where I drop exclusive weekly videos breaking down these institutional footprints, the exact stocks and ETFs I'm loading up on right now, and the millionaire blueprint to think like the top 1% instead of chasing CNBC panic. It's not hype. It's the edge that turned followers' portfolios from average to seven-figure compounding. Links pinned. Don't sleep on it. Most people miss this, but BlackRock's shift is pure smart money behavior. Institutions always move first, quietly, in size, before headlines scream, crisis. Retail. They react to fear, buy high, sell low. We've seen this movie before. .com 2000. Big players rotated out of overvalued growth bonds into cash equivalents right before the Nasdaq plunged 78%. Retail chased the bubble. Smart money was already gone. Or 2008. Mortgage-backed bond yields spiked, forced liquidations cascaded, stocks cratered, until the Fed flooded the system. BlackRock and predecessors positioned ahead of the panic. History doesn't repeat, but it rhymes. Another parallel. 2011 debt ceiling fiasco. S&P downgraded U.S. credit. Yields jumped. Stocks dropped 17% in weeks. But who bought the dip? Buffett, institutions. They scooped quality names while retail panicked. Today feels similar. Debt ceiling talks heating up again in 2026, gridlock in D.C., but BlackRock isn't waiting for the drama. They're already underweight long treasuries, overweight AI, resilient U.S. equities, and loading emerging markets debt for diversification and yield. One more historical echo: the 1970s stagflation era. Bonds got crushed as inflation raged, real yields went negative, but stocks in energy, commodities, and export-heavy names exploded once the dollar weakened. We're not full stagflation yet, but with debt-fueled spending, tariffs looming, and a softening dollar, it's rhyming hard. BlackRock sees a weaker dollar boosting U.S. multinationals' overseas earnings, Apple, Microsoft, Nvidia, when converted back home. That's rocket fuel for the Magnificent Seven and AI infrastructure plays. The mainstream narrative? Pure bedtime story. CNBC and Bloomberg call it cautious rebalancing amid debt concerns, or tactical underweight due to supply. Vague, clean, keeps you uncertain and sidelined. They want you terrified of the $38.56 trillion number without explaining the play. Higher yields act like a pressure cooker, squeezing zombie companies, consolidating market share in winners, and unleashing capital into growth. Headline logic says, bonds bad equals stocks doomed. Reality? BlackRock's still pro-U.S. equities, just not via long bonds. They're betting on dispersion. AI winners surge, laggards flush. Simple analogy time. U.S. bonds are like that overcrowded highway everyone piles onto for safety. BlackRock's exiting the on-ramp early, taking the express lane to emerging markets debt, higher yields, less crowded, and quality U.S. stocks, growth, productivity. Retail? Stuck in traffic, honking at rising tolls, higher yields, panicking when the jam slows. The window to position closes fast. By the time the evening news explains, BlackRock shifts. The easy money's already gone. Let that sink in. With debt growing $6 billion plus daily, AI CapEx front-loading, companies digging holes now, filling them with revenue later, classic circular spend but explosive, and global central banks easing while the Fed stays cautious, this rotation is structural. Emerging markets? BlackRock's pounding the table, valuations cheap, dollar tailwinds, central banks cutting aggressively. U.S. stocks? Overweight on AI because productivity offsets higher rates. Private credit, infrastructure? Filling the gap governments can't fund. Critics scream, but tariffs, but recession risk. Sure, volatility's coming, debt ceiling theater, policy uncertainty. But remember, 2017 tax cuts, bonds sold off hard, yields spiked, yet stocks ripped 21% as capital rotated into growth. Or 2018 yield curve inversion, signaled doom, stocks dipped, Fed pivoted, 35% rally followed. Rhymes again. Here's how to win this. Don't chase bonds for safety, they're losing their halo. Allocate 20 to 30% to emerging market debt ETFs, think EMB, local currency plays, for yield and diversification. Domestically, load quality, low debt tech giants, AI enablers, infrastructure names. Avoid junk credit. First, to get flushed when spreads widen. Gold, BlackRock's nodding at it as a diversifier. Position before certainty. Certainty is retail's graveyard. Promo break. In Buffett Academy, we don't guess. We track these moves in real time. Last month alone, members caught 12 to 18% gains on AI-adjacent underdogs and EM debt plays before the herd arrived. It's weekly stock/ETF picks, macro breakdowns, live Q&A, no fluff, just edge. Pinned comment has the link. Join now while spots are open. Think like the institutions, not the headlines. Diving even deeper. Why emerging markets specifically? Reader highlighted favorable valuations, soft dollar, and bond supply issues in U.S. credit. EM debt yields higher carry with lower duration risk in many cases. A weaker dollar? It's like free leverage for U.S. exporters. Earnings explode on translation. AI spending? It's self-reinforcing. NVIDIA sells chips to hyperscalers who build data centers who need more chips. Circular, yes, but printing cash until saturation. BlackRock sees this lasting years. Urgency check. Debt hits $39 trillion potentially by mid-2026 at current pace. Term, premium rising, bond vigilantes stirring. If yields push toward 5% on the 10-year, stocks reprice. But winners consolidate power. Don't wait for the next Fed meeting or debt ceiling deal. Smart money's already moving. One last history lesson. 1980, silver bubble. Institutions front-ran the squeeze, exited bonds for hard assets before the waterfall. Retail piled in late. Same setup. BlackRock's repositioning now. Vanguard/State Street will follow. By summer, if this accelerates, the rotation becomes obvious. And obvious means expensive. This $2 trillion scale signal via underweight plus reallocation isn't doom for U.S. stocks. It's the green light for a selective bull run. Rotate smart, quality growth, EM yield, avoid duration traps, survive the noise, thrive on the shift. If this breakdown fired you up, smash the like button. Helps push it to more investors who need to hear it. Subscribe for weekly signals like this. Hit notifications so you catch the next one live. Share with a friend still glued to fear headlines.